All right, welcome back. Is it me or is the market starting to see through the tariff tantrum? Now, this week started off yesterday with a lot of chatter concerning what the president is going to do with the tariffs and all the countries that have been either dragging their feet or ignoring any efforts to get a deal done. Now, there really wasn't any other news besides Elon Musk and his America party. So if we would have had this same setup back in April, I'm afraid the market would have reacted much more violently to the downside. But I think investors have learned and now have a fuller picture of these tariffs and the president's America First agenda. Now, time always is a bit of a help, I think, right? And as is a little reference. Now, you see, there was a genuine concern that the president was destroying our economy in front of our very eyes a few months later. A few months ago. But even now, later on, investors have learned that not to bet against the agenda, that he's probably one of the biggest American cheerleaders for capitalism, right? So my next guest, he's got to navigate the same waters that we talk about here every day. Welcome into the show, please, Mr. Craig Bolanos. He's co-founder and wealth advisor at VestGen Wealth Partners. Thank you very much. He's up in Chicago. Craig, we've had a good show today. It's been pretty interesting, but I wanted to get your perspective because you manage money a little bit different than everybody else does because you're more of a singular guy, right? You have to do retirement, education, health, by person, much more bespoke. But I think that the market's now growing up a little bit, and we're not seeing the same moves that we used to, which is probably bad for the people that still want to get back in the market. They see some negative tariff news. I think they're going to buy the Dow 1,000 lower, and it ends up being 200 lower. What say you?
Here's what I say. It's about the big four right now. Taco remains in place. Trump always chickens out. The economic growth, it's slowing, but it's still okay. Rate cuts, oh, they're coming in September. And most importantly and recently, yeah, the big beautiful bill, it's passing, but the global bond market is not punishing America. You take those core four items, people are looking past a lot of things. And Scott, have you seen the earnings estimates for 2026 on the S&P? They're coming in at 295. That's nearly 10% increase from where we're at this year. Wow. Rose-colored glasses? I don't think so. The soft landing's intact.
Well, I tell you what, it wasn't that long ago that everybody was falling over themselves to downgrade their year-end expectations. And now you're starting to see, which makes me a little bit more comfortable because, yes, hand up, I am a bull. I like what I see when they're racing to fall over themselves to raise those expectations. 6 months into the year, I think I wouldn't be lying, but we had single-digit gains in the equity indices. Nothing crazy, but we're definitely, that's a great effort considering where we were. But I think that with what can be unleashed with some of the things that we've talked about on this show with that big, beautiful bill, regulation, I'm not saying I want a rate cut or we need one, but we'll probably get one. That's not going to hurt. And again, the last thing that we've all talked about all day long here today is the money on the sidelines. What say you?
Well, yeah, I mean, you take my core four plus the big one, the earnings estimates. The way I explain it to a client, if they say, "Hey, what's going to finally make everything worse?" It's just this. If Taco got invalidated, oh, it'd be terrible. If you see a ginormous, if that's even proper English language, rise in reciprocal tariffs, terrible. If the Fed decides to completely anchor with a air quote wait and see policy, I wouldn't be loving it. And as long as you can keep that 10-year below 465, 470, I think stocks remain in the dominant position. So, hey, buy the air pocket 5% dip when it pops up in the second half of the year. You know we're going to get one, but there's not going to be any big travesty again like we saw in March and April.
No, I agree. I agree with you. And this is going to be one of those times where I think that your investors, I'm sure you talk to them about that. I talk to folks all day long. I don't have any investors. I don't have a license to do that. But I would advise that, you have some money on some dry powder because, we'll probably get something where you're going to be able to get some stocks on sale. Not as much on sale as a lot of folks that missed that rally from April the 8th would like to see. And that's kind of the gist of my segment here is I feel like you've said it. These downdrafts are shorter and they don't last as long they're not as deep and don't last as long. And I think that's because there's so many people that need some work they've got work to do. They need to make up some time.
There's a lot of work. There's a lot of catch up for people to do. Too many people miss this. But for all the optimism that I'm sharing with you, which by the way is founded in reality because it's based on data, it's not based on sentiment, Scott, I got to implore everybody to still maintain proper risk budgets. I mean, there's a reason that you should be rebalancing your portfolio between asset classes. There's a reason people should pay attention to geography, which is a discussion on valuation.
Right.
So don't simply fall asleep and own just S&P. I don't think that's the move to make. I think the second half of the year, the month of July, is to reassess what do you want your money to look like when you grow up, and then work backwards from there to engineer it.
Do you have any, I mean, I don't even know if this is something you do. If you don't, that's fine. But do you have any year-end expectations for the S&P 500? Do you look at things like that?
Yeah, I do all the time. And I think, I'm hard pressed. I mean, I think we're honestly a shade away from fair value. Do I think that if things continue to go right, that we can be trading in that 65 to 6600 area on the S&P by year end? Absolutely. And then we'll all reset our sights on what we need to do to make sure we win in 2027. But I am so happy with the way the script has played out thus far because, yeah, to say you weren't as nervous as a long-tail cat in a room full of rocking chairs in March and April would be disingenuous. Everyone was, because the pace of the news was so violent and torrent.
It was, and the news was very, very, very negative. You're exactly right. Craig, always love having you on. I like to get what your point of view is because it's interesting and it's not quite one we have from other folks on the show. So appreciate it. Thanks very much for coming on, Craig Bolanos. He's with VestGen Wealth Partners.